I'm Scott Callon, Chairman of Ichigo. Thank you, everybody, for joining today. This is the H1, sorry, my apologies, FY24 H1 corporate presentation. I am joined today by Ted Foodstuff, who is our lead independent director. And we also have with us Dan Motisaka, who is the senior member of our finance team and the head of our IR. So let's jump into it. H1 summary right in front of you, page 7. Earnings are very strong. So all-in operating profit. So these are the two key numbers to understand us. All-in operating profit OP is up plus 124% year on year. So we're running at 2.2x. GAAP EPS is up 130% year on year, 2.3x. The major growth driver for us is hotel earnings. This is an asset that is economically sensitive. It's an area where we have significant expertise and the ability to deliver value. And it's, it was devastatingly bad. Must be understand that during COVID. And it is now extraordinarily positive. Because it does have volatility, we manage this business in terms of our asset allocation, no more than 25% of total assets. Right now, it's running at 18%. We're fine with that. But it is a very productive business. In part because even though, in the hospitality area, you have things like you have restaurants, you have hotels. Japanese restaurants are arguably the best in the world. It's not clear at all that Japanese hotels are. So there's a gap there in terms of the ability to provide value for guests. Our stock earnings and fixed expenses ratio is now 230%. We've designed this business to be structurally profitable. So we make money in all environments. We will never go negative. We did double the size of our self-storage business and we sold it and generated gains on sale of about 3.9 billion yen. And the other thing to note is we launched our second Ichigo Residence token, put 5 assets into it, that sold out immediately as did our first digital token. We are supporting the growth of Ichigo REITs. We provided 5 hotels, Ichigo Hotel, and by that I do mean provide. We put 2 of our best hotels into it, are not boutique hotels, one in Yokohama, one in Sapporo. We supported a third-party share allotment to finance Ichigo Hotel's growth. We have been buying in Ichigo Office and Ichigo Hotel shares to strengthen sponsor and shareholder alignment. We would expect to own about 10% of those shares over time. And this is just to make sure that you avoid the chronic negative case of a sponsor who doesn't care about the REIT shareholders. Now, we care as a matter of philosophy. We exist to serve shareholders, not just our own shareholders, but for REIT shareholders, because they are also our own shareholders. But in terms of creating materiality and the alignment, we are also co-owners in size of both Ichigo Office REIT and Ichigo Hotel REIT. And we're doing non-gearing share buyback right now, what's our forecast for the play out there? Sure, it's 65%. I pointed to our stock earnings, fixed expenses, 231%. That peaked pre-COVID around 234, so we're back to where we were. And this is an extraordinary. I told you the most important metrics for us are all-in OP and cash EPS. This is also vitally important. This tells you how durable the business is and how structurally profitable it is and it's stock earnings are up very substantially. That is driven by our hotel business. We do classify, and to be clear, and I always try to be clear, so let me know if we're not. We do classify anything that's contractual rent as stock earnings. That includes hotel earnings, which have more volatility and any of other contractual rent earnings. But that has been a positive contributor. And so there's been a significant growth in sustainable real estate, particularly inside of my hotels, which were devastated during COVID. We provide all-in disclosure. We aspire to be, and we work to be, and I'm hopeful that we actually deliver on this for all of you, tenacious in defending and growing value for our shareholders. One of the choices we've made is to use tax shield that you allow to have if you classify your assets as fixed assets that allows you to take depreciation. It means you generate more cash for all of you. The accounting element of that, though, is it means you're holding assets and fixed assets, and so as a result, when you report these numbers as make profits on it, as extraordinary profit as opposed to operating profits. So we actually reverse that to give you more earnings transparency and show you on an all-in basis what OP is, because it's just an accounting classification. It's an accounting classification that's meaningful because it generates more cash for all of you. You can see across the board substantial growth, and it's more visible in all in because that's where we're doing a significant amount of our activity again. It's occurring in assets, we want to get a tax fuel, which is really good about. So very strong. Probably worth pointing out, for previous to a question being asked, if earnings are so strong, why did you upgrade your forecast? You know, and that's something that we gave some thought to. And the honest answer is we expect, and I'll touch upon this later, significant contribution activity that we classified as flow earnings, and we made a decision that will allow that activity to occur and the earnings results to come. And if that happens in the way that we expect, we'll have, and there's significant contribution. You can see on the segment earnings details, growth in asset management business. That's linked primarily to we've got growth in the hotel asset management fees. We do run both of these REITs, Ichigo Office REIT and Ichigo Hotel REIT. And everything I told you, we try to be tenacious for shareholders, includes the REIT shareholders. So we therefore have a significant amount of performance compensation in those fee structures. The hotels were devastated. The hotel shareholders were devastated. We were punished as a result of that totally appropriately as the asset manager when revenues came in. Now that revenue is surging and hotel REIT, we're benefiting from that by having participation in the asset management. You can see an explosion in increased OP and sustainable real estate business, and that reflects this is designed to perform well in both negative and positive environments. And this environment is positive. Clean energy, it's going to come off this year. That's one off. We have to do some plant maintenance that happens on occasion until a major plants are going to and that will. I'll go kind of quickly through, and in fact, we barely touch on this. There's a fair amount to talk about today. This is point out kind of the key elements, and this is ongoing disclosure to provide you all of you. We have a hybrid earnings model with both stock and flow earnings. These stock earnings are, despite everything that went wrong in COVID, you can see they're actually very stable over time. We have embedded forward earnings, which is to say that our full economic earnings from value add exceed our accounting earnings. You can see that we have significant capability in value add that shows up by having actual gains in sales when we sell assets substantially above what third-party appraisers would say those assets are worth, which is to say that they kind of have backward-looking, not taking fully into account the value activity that we do. And at the end of the day, next slide, please. We believe that the ultimate source of value is generating cash. And so we're extraordinarily focused on economic operating cash flow that consistently, and it's another version of saying our economic profit is consistently higher than our economic profit. We have a strong financial base. We continue to fund very low, despite everything that's gone wrong in the world. And we expect to see some increase in interest rates. We do believe that that is wonderful beyond belief, which is to say that the root of the increase in interest rates is inflation. And we have 270 billion yen of real estate assets that will benefit very substantially from inflation. You're finally seeing an increase in replacement costs. Our existing assets, kind of steel in the ground, is more valuable. And so there will be some small increase in interest costs that are going to be more than compensated for by an increase in earnings. we have significant activity sustainably in ESG finance. That's important because we work to serve the world. It's also the case that these ESG financings have much better terms and conditions. Japanese financial institutions really do want to lend to sustainable firms who are undertaking sustainable activity. So this is great borrowing. It's currently 34% of our total loans, and we aspire to increase it. We are selective on acquisitions and sales. I'm pretty sure we haven't changed the title of this page for like 6 years, because that is fundamental to who we are. And so we both acquire and we sell. You'll notice on this page that we've been very little done on the sell side for Ichigo owners. I'll talk a little bit about that later. So we're net sales year to date, but you'll see a significant activity both in acquisitions and in sales in the second. We're talking about what we're doing in hotels, and to go back to the root cause of why we're involved. Hotels are harder, so it's not as easy for companies to add value. There are more operating assets, so having significant capability in the space allows you to deliver more value. One and two, we believe they're kind of an undermanaged asset class in Japan. And three, they are linked to not just kind of global GDP and income growth, but also near to Japan, Asian income and GDP growth. Japan is a preferred destination. The ability to access inbound travel gives you a growth opportunity in the industry. So we were very involved in this space. We have been for years. You can see we have our own hotel operator called 15 Hotels. We have an AI-based hotel revenue management system, which is very, very successful to drive kind of pricing optimization. We retained our employees during COVID. We provided multi-skill, multi-task training. We've maintained our vendor supply chain. What's happened a little bit during the COVID period is you had some fall off of supply, which is hard for guys who allowed it to go away to reinvent. And lose your employees, they're hard to get them back. So we're very well positioned for an uptake in the Japanese hotel market. Some of the things that we're focused on: value add, our own branding, our own hotel operations at this point. And I will avoid going on the overwhelming length in this presentation. I will have a Q&A. We can go through more things. Our focus is value add. We focus on guest functionality, comfort, satisfaction, and sustainability. Ichigo is not a passive owner. We always have a plan for an asset, how we're going to improve it, and we execute that plan. And adding 15 hotels and hotel operators given us the ability to be quick in our response to guest needs, provide an non-asset earnings platform for ourselves, and it's been very, very helpful in increasing our sophistication of really delivering value in hotel space. Our RevPAR, so revenue per available room, is going up. It collapsed, as you can see, under COVID. We expect it to go substantially above pre-COVID levels. And by the way, this shows total amount of stock ratings on hotels on the left. That's actually on about a 10% smaller asset base than what we have today. So there has been a surge and continuing surge in hotel income that we're experiencing. Here are two cases of value add. One is the Tokyo Shinjuku. So this was our first boutique hotel. We purchased this asset in 2016. You can see before that value add, RevPAR was about 9,000 yen. It's currently about 16,000. It's actually currently higher than that. So it continues to go upwards. So we increased our FAR by 82%. This was a relatively significant CapEx experience, but it included, as you can see, a full-scale renovation, including earthquake resistance. But still, all in about $20 million into the hotel. That's order of magnitude of about $100 million hotel. So the economics on this are enormously powerful. By memory, I think the going in cap rate was about 4%. It's currently about 10%. So this is what we did. We took a very old hotel. was old, it was fusty, it was really doing just group tours and turning it into the hotel that offered really excellent experience for our guests. Right hand side is another set of hotels, one by Villa Fukuoka and one by Terrace Fukuoka. We bought these hotels also in 2016. And kind of redesigned, we added a variety of hospitality services that were not available. In this case, we're part of 40%, much smaller capex burden. Again, in this case, about $5, $6, $7 million in this, but enormous IRRs on the investments. And we continue. This is what we do. As I told you, we've shrunk our hotel balance sheet by about 10%. We don't expect to own a ton of hotels. We would expect to put them in Ichigo Hotel REIT, which has a desire to get to scale and grow on behalf of its shareholders. But you can expect this to continue very involved in the hotels. We own Hotel E Plaza, which is arguably Japan's most important landmark hotel. And which is to say, it was designed by Rossi, who's one of the world's great architects, opened in 1989 during the peak of Japan's bubble, and it is an extraordinary asset. In terms of architecture and design, we have refreshed it and brought it up to today's needs. It's located in downtown Fukuoka. It's truly extraordinary place, and here in Fukuoka, and this is SCU stay there. You would like it a lot. It's just it's really beautiful. And the not hotels, the Palazzo, the 1-5 hotels are all examples of us moving and offering better guest services in order to capture significant demand for that kind of quality. You can get a lot of budget hotels in Japan. It's harder to have this guest experience without paying kind of $500, $600 a night, and we have price points that are workable. So we think there's a significant opportunity to deliver more value in the budget and more value than kind of classic kind of luxury 7-1-3 hotels. We are, as I indicated earlier to you, we're working to support Ichigo Hotel REIT's growth. Through our best hotels, the not Sapporo and Yokohama. We exist to serve our shareholders, including the REITs shareholders, as I said earlier. So it's important to know that we have created a revenue forecast for those hotels. Now, ongoing basis, I've touched on a number of these things already, but we see an important opportunity to grow the REITs. I've touched upon this before, but one thing about inflation, Japan really didn't experience it for decades, and so people could have money in the bank and not get hurt. That doesn't really work right now. So being able to support the needs of Japanese savers by providing real value and genuine return is something that's more important than anyone else ever did. So we see really the influence that being related with that. Japanese real estate offers powerful returns, and our research up to basis, but I will arguably think that becomes Ichigo continues to grow. You can see sales this year to date have been small, and then you have kind of on the right hand side our forecast. This is target, but it's really kind of more forecast, which is 5 times higher. So we expect to do a lot more on the sell side this period, and I guess things done that we certainly think is substantial on the sell side. We have been expanding our sales channels. I talked about this before. The tokens. So these are securitized real estate assets as tokens on the blockchain. And as someone who is, and I'm allowed to say this, roughly my age, who's been deeply skeptical of crypto, in part because it doesn't seem to be backed by anything. In this case, this is backed by actual assets. And so really what it is an opportunity to buy real estate in a different form. So you can buy via REIT, you can buy via owning our company, another real estate company. There are small lot transactions out there. We're also involved in, and you can also now buy Ichigo residence tokens, which are digital assets, and the securing a real on there backed by these physical real estate. You get your return on it. So this is another way to own real estate, and it's remarkably popular. I mean, and again, this is to full disclosure. I was deeply skeptical about this. It's like, who's going to buy this? Why don't they just go buy a REIT? And it turns out it skews male, it skews young. There's this huge demand for this, and it's equivalent to a REIT. To give a fantastic return, and so we're delighted to have another set of investors who are participating in Ichigo real estate out there. The clean energy business, we will grow. A little bit of turn down this year on maintenance. We've got some activity in green biomass. We have much bigger activity in non-FIT solar, although because the feed-in tariff is so much higher for biomass, that actually makes a pretty good contribution. This is a business that we've been doing. We are involved in a share buyback right now. We think the shares are cheap, and we think we should buy them in. And because our cash generation is so substantial, we can continue to invest for growth at the same time as we buy our shares. We also have a progressive dividend policy, which is a way of saying we don't cut a dividend. And we'll grow it at a DOE dividend equity payout ratio of about 3%. For a long time, that meant we didn't raise a dividend through the COVID period. We stepped up the dividend this year, and then we expect to grow in the future. The JV shareholder program, which was super not interesting when COVID shut down the daily, is back in its very substantial way, and something. And again, I won't repeat this, but it represents for us for shareholder program, and you can go to as a shareholder in any of our entities, including the REITs and the listed solar power producer, to be allowed to go to JV structure. We are working to protect the global environment. We are climate positive. Our CO2 reduction is substantially higher than emissions. So we're pushing up both production and our emissions. I'm sorry, pushing up both the production and reducing our emissions so they gap between. We also, and this is on our own emissions reduction, we're continuing our renewable energy transition. It's 0.7% of our total electricity. It's coming from renewables, and we expect to get 100% continuous. And this is the final part of the presentation. We continue to improve the environmental quality of our assets. We are always guarded in space, and the company that cares about both planet and communities around us, and have received very high accolades from independent parties who do environmental certification. So that's what I have. Thank you, everyone, so much for joining. Let's go to Q&A. I never get input, but I'm genuine in saying, if you have input, and we're also we're very much welcome that. We work for you. So anything from anybody on any topic. Greg.
Can you hear me?
I can hear you. Thanks so much. No, I can
Okay,
hear you.
great.
Thanks so much.
Great. No, thank you very much for your presentation. I have three questions. The first one is regarding, regarding Ichigo owners, compared with the initial forecast for gross profit margin. Are things still kind of going okay versus your forecast? Is it a bit better? And also, are you seeing buyers taking a bit longer time to get financing or not? Would be my first question.
No issues at all. Owners is going great. Not a problem with buyers getting financing. Yeah, no issues at all. In fact, we're getting, per plan, we're getting bigger. And that links directly to what I said earlier, which is demand is growing. As Japanese inflation is going to 3%, and banks are still paying you less than a basis point. There is just this huge appetite for, and remember, owners' assets are super prime, brand new residential, overwhelmingly in Tokyo. We're doing a little bit outside of Tokyo, so they're a very secure return asset. So things are great.
Understood. And so I've got two more quick questions. The first is an update, please, on the Trapedia building. How is the occupancy rate progressing now?
I mean, our curse, so this is for everybody. We have one very large office asset, and I regret. I mean, it's actually been okay, which is to say, it was remarkably successful going into COVID, and we lost a whole bunch of tenants post COVID. It's still kind of offered. I didn't return, but it really points to our kind of original thesis and ongoing reality that small and mid-sized office is such more secure, stable, and value-add capable asset class, and it's a better asset class. So we have one big asset yeah. It's currently running at, I think, about 6% occupancy right now. We're actually, the good news is leasing activities picked up. So there was a scenario there that was going to be hard, and in part, we just really worked hard on it. We've got if you're interested in going there, we have an incredibly nice cafe on the first floor. It is on Tokyo Bay. It's a really interesting place to be. But that's been hard. And at this point, leasing is being
Understood. Thank you. And my last question was on the hotel business. Obviously, you've had a phenomenal success in raising RevPAR. I mean, right now, as we know, especially for boutique hotel in central areas of the cities, situation is extremely good. How sustainable you think is this? Can you keep RevPAR on average at 10,700 for like into next year? Is that something sustainable, or are we kind of peak RevPAR? Would you say?
RevPAR is increasing. So the numbers that I've shown you are averages, and so the current numbers we're experiencing are high. There is something going on that's worth touching on, is that the market has bifurcated somewhat between inbound and domestic. Domestic travelers, both business and leisure, travel budgets have gone up a little bit for businesses, but still, they haven't gone up 50%, 70%, 80%. And Japanese wages are not going up 6%, 7%, 8%. So you really do have a market where the ability to serve the global inbound traveler. And look, some folks come here on budget, and you want to serve them. They're gonna make choices about the hotels that are similar to Japanese domestic business travelers and leisure travelers. But where I'm going is the ability to serve the global guests is increasingly very, very important to generating the maximum RevPAR out of your hotels. So we've actually taken a lot of steps, and we've done a lot more hiring of staff that is global, not Japanese, and they have a mix of nationalities in the hotels, staff to serve inbound guests. And so that's something we're pushing hard on. And as part of, and our price points actually are very low. And so the exciting element is we are very well positioned at this point to serve inbound guests, and the price points that inbound guests are used to kind of on a quality adjusted basis. There could be 30, 40, 50% upside. So, by no means, the existing data is Greg is that RevPAR going up is not big, and we see substantial upside.
Okay, great. Thank you very much.
We're open for any more questions or comments. Will.
Hi.
This is Will.
Hi. Yeah, thanks for hosting. I listened to the Japanese earlier, and this just might have been my mishearing, but on Tradepia, my note says it was 54%. The target by the end of this year was 70%. This occupancy, obviously, and that it was your goal was to try to raise it 10% per year, and that you were getting close to that target of 70. and it was slightly better than planned. That was how I heard that. Can you just confirm that? Is that because that sounds better than what you just mentioned now? Like the if you're still in, or maybe it's right. Maybe you're saying mid 60s, but by the end of the year it might be 70. Can you just confirm that? That'd be the first question.
Okay, I hedged it a little bit. We have the current number on it. No. Sorry, we're switching to Japanese. Right now, right? Yeah. So it's at 60 right now, and the target is to get to 70. And yeah, that has become, because leasing activity has picked up. And so to be clear, everybody, end of our fiscal year is it's February end. So
Got it.
that's possible. I mean, it's kind of like, you know, where we are on our forecast. I tend to prefer to under promise and over deliver. But yes, things are picking up a bit of that.
Okay.
This is the official name of the asset, which is which is located in Nevada.
Thank you. And on the page 31 on your solar non-fit business, am I right that that's a new addition to this presentation? Is that a new project that's been confirmed, or has that been around?
You know, it's relatively new. I think we may have had this in Q1, but we're doing more in non-fit, and the numbers are bigger. So yes, you're right. You've noticed the bigger number.
Yeah,
we're making good progress in this. This is good.
And is this going to be for the production of power at, for example, factories and sort of doing it on behalf of corporates that want to increase renewable energy?
Yeah,
sort of the PPA plan. Is that what this is?
That's exactly right. I mean, it may not be. I don't think it's going to be on factory sites per se, but we as when people ask me internally, are we allowed to do development? It's like, yeah, only if there's no development risk. So what we've done with the FIT assets and was built in kind of structurally into that was you make an agreement with EPCO, the electric power company, so they're going to buy the power from for 20 years, then you build the thing. And this is going to be the same thing. It's not FIT. It's going to be corporate contracts, and we're going to understand who's going to buy the power from us. And so, and very powerful and secure economics.
Okay, thank you. And there's upside from this sort of scale. You think maybe going out 1 to 2 to 3 more years?
Definitely.
Okay, thank you. And now by asset class, or I guess let me reconfirm what Greg was asking, and the 50 billion forecast for owners. Can I just you left that unchanged, so it's obviously still a target. Is it just you didn't want to change it, or you think realistically that target is still in the cards? Can you sort of give me color on how you feel about that?
We expected this number.
Okay. Thank you. And finally, just by asset class, I mean, obviously you had success with the office asset sales to the REIT. You had the success with the hotel sales to the REIT as well. Are there really any? There's no troubled assets at this point where cap rates might be rising and just buyers just aren't there, or is it still a pretty tight market across the board? Would you agree with that assessment?
We have had only one asset we've struggled with, which is what we're talking about today, the big asset in the night. Everything else is going fine. I mean, the work from home impact on office assets has been radically different, for example, US, in Europe, and for example, in Japan. So across the board, things are good. And quite honestly, one of the things that's gotten better in the last year is inevitably kind of when you're based in New York, because that's where most of the US real estate funds were based. And they're watching the devastation in the office space in the US, they pull back their horns everywhere. And so we were competing with big US private equity real estate funds for office assets in a way that it kind of just pulled back. And so the ability to acquire, and these guys were involved, and they were generally kind of outsourced to somebody like us to try to get something done. But they were competing with some small mid-sized office assets also. So it's become much easier to buy assets that we want to own at pricing that we like. So things are good. We'll stop.
Okay, thanks. And lastly, yeah, I'm just looking at the Ichigo Office REIT monthly disclosure of occupancy, quite remarkable, back up to 96.6% in that. I kind of assume that your offices at Ichigo group are similar in type that are in your REIT. Can you just give us a breakdown on occupancy at your offices and your retail assets at this juncture?
So retail tends to be more master lease, and so I'm fully occupied. I mean, and it really is more a game about how you do your kind of participation in sales. The office numbers are pretty similar to the REIT.
Excluding Tradepia.
Being Tradepia, which is kind of problematic, because it doesn't look anywhere near by 97% occupancy. And that's the thing about the office space, is that we went from 0.5% vacancy to kind of roughly 5% vacancy, something like that, in the office suites during COVID, and in our assets also. I mean, it was again the assumption. And that increased vacancy was, there were lots of businesses that were impacted negatively by COVID, and so they took some, and the guys that were impacted by that, take some action. And they also have inevitably about when we do primarily kind of central city, really well located office buildings, as you know, and so generally the first floor is retail, and the guys. There's some elements of COVID retail as well, like supermarkets and drug stores, and there were the guys where restaurants were devastated. And so you had some negative impact on, even though it's an office asset, you had a negative kind of retail impact that came from each other. And so that's all kind of works itself out. And so, yeah, our occupancy is creeping back up. And actually, I've talked to the guys at the office REIT, and I told them, you really need to tell the story in the way it really is. We believe optimal vacancy is around 32%. It is not zero. But the problem with zero is, if you think zero is the right number to be, then anytime you have a vacancy, you try to fill it immediately. And guess what? Actually working the asset in the leasing process, spending some time improving the asset to lease at higher, rents is a much smarter choice. And so we actually are running optimized on all of our assets and the REIT assets, something like 97 to 98% occupancy. That was really good vacancy. So I know I didn't give you actual numbers, but they look broadly similar, except for the which we just indicated as 60% of the targeted 70 by the end of the fiscal year.
Thanks. One last question, if I may.
Thank you.
So the press release on the sale of the self-storage business announced a few weeks ago, I guess, it said the seller requested non-disclosure of the price and et cetera. And I haven't had the chance to dig through your financial filings. I'm just wondering if you can qualify roughly what the contribution to extraordinary profit was from that transaction.
Yeah, the number is 3.9 billion yen.
3.9, okay. Yeah. On the extraordinary level, not the operating level. Okay, perfect.
Yeah. So that was
there it is. I see it. Gains on sales of affiliates. All right, I just noticed it.
Okay.
Perfect.
I need to give you a hard number quickly.
That was easy. That was easy.
It was. Thank you.
All right. Thank you, Scott. Appreciate the presentation.
All right. Thank you. All right. I think we're going to bring it to a close. Thank you, everybody. To reiterate the point, things are good. And we fully expect to deliver to you on that promise. So stay tuned. And thank you everyone, a lot. Your time is valuable. We're grateful for you to spend time with us. So have a good day, good morning, good evening. Take care.